This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Massive rebound. American businesses ramped up hiring, alleviating fears the economy is sagging and sending the S&P 500 just shy of a record close.
Goldilocks market, job growth is back. The Fed is on hold, volatility collapsing. Is this the perfect scenario for investors?
The results are in, and tonight you'll meet the entrepreneurs who are using social media to spur political discussion, a different kind of bright idea. Tonight on Nightly Business Report for Friday, July 8th.
Good evening, everyone, and welcome. Stocks touch all-time highs, and for that, you can thank a blowout jobs report. The employment numbers for June came in much stronger than expected, showing that one of the best-performing parts of the economy is still humming along after sputtering earlier this year in the spring, and the buyers came out in force today. The Dow Jones Industrial Average up 250 points to 18,146. NASDAQ climbed 79, and the S&P 500 added 32 to close just shy of a record. But the index did nip above its all-time closing high during the session today. And the rally was sparked by the creation of 287,000 new jobs in June. Big increase over the revised gains of just 11,000 in May. The unemployment rate did edge up to 4.9%. Average hourly earnings rose modestly. Hampton Pearson has more on the job market rebound and what it may mean for Wall Street, Main Street, and the Fed.
The June jobs surge showed employers recovering from 2 months of weak hiring, with the job growth on a roller coaster, adding just 11,000 new workers to payrolls in May compared to today's blockbuster of 287,000.
It's really important when you have a lower than expected month, as we had last month, not to jump to conclusions.
The leisure and hospitality sectors led the way in June, adding 59,000 new hires, with healthcare close behind, hiring 58,000 new workers. But the unemployment rate rose to 4.9%, with little growth in wages, and the 3-month average is just 147,000 per month.
The story from the economy is pretty clear. We're moving towards full employment. We're probably very close, and we are starting to see some clearer signs of stronger wage growth.
Data for that June jobs report was collected before Great Britain voted to leave the European Union last month. So economists don't have a gauge on the impact on the American job market. But they point to the 2.6% year-over-year gain in wages as a sign of an economy moving closer to full employment. Reasons enough, economists say, for the Federal Reserve to stay on the sidelines when it comes to interest rate policy.
This is a really important number for the Fed. This is the exact number the Fed wants to see, right? They want to see us recover, and this really supports the notion that Janet Yellen had last week or last month that this is an aberration.
Wall Street Fed watchers say the combination of the slowdown in job growth plus the economic uncertainty from the Brexit vote are increasing the odds of no Fed rate hike this year. For Nightly Business Report, I'm Hampton Pearson in Washington.
Now to Bob Pisani at the New York Stock Exchange.
What happened? 2 days ago, we were talking about a trading range for the S&P 500 between the old high of 2130 and the February lows of roughly 1800 or so. We came very close to those historic highs today, closing just shy of the 2130 level. Regardless, it's been a remarkable rally. All right, so what happened? The bulls are arguing that the strong June jobs report has created a Goldilocks scenario. We're back to strong job growth, but the Fed is still likely on hold for some months at the very least. The bears are insisting this rally has nothing to do with fundamentals or even with the idea that there is some dramatic improvement in the U.S. economy. They say that the rally is due to unusually heavy demand for both U.S. stocks and bonds, partly due to foreign demand and partly because investors are forced into U.S. stocks because of a lack of alternative investments and because Europe and China stocks are problematic right now. You know what's amazing? Either interpretation means stocks rally. They both can be right. And it was a broad-based rally today. 9 stocks advancing for every 1 declining, and new highs kept expanding throughout the day. So we had industrial names like General Electric and UPS suddenly on the new high list. All right, where do we go from here? We go to earnings, which start on Monday with Alcoa, and we find out how much this whole Brexit thing might impact the second half of the year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So we got a robust jobs report for June that had stocks touching new highs. But what are the numbers really telling us about the health of the economy? Let's turn now to Josh Feinman, Global Chief Economist with Deutsche Asset Management, and Stephen Wood, Chief Market Strategist with Russell Investments, for more analysis on today's jobs report. Josh, I'll start with you. I mean, it looked good on the surface. When you dug deeper, were you equally as satisfied with the report?
Yeah, I mean, I think the report was reassuring. It certainly helped to allay some of the fears that we got from the previous report. You have to smooth through the volatility, though. And when you do, you see job growth running about 150,000 over the last 2, 3, 4 months. That's a healthy clip. It's enough to continue gradual progress in healing labor markets and edging back towards full employment. But it's not as strong as we were seeing, in the past couple of years.
Josh, why did May lay such an egg?
You know, the numbers bounce around from month to month. This is why you can never hang your hat on any one particular month. You got to smooth through and look at the broader picture. And as I said, that broader picture suggests that labor market is healthy. It is improving. I don't think it's quite back to full employment. I think there's still, a residual pool of folks who could be drawn back in, some folks working part-time who would like to work full-time. So I don't think we're all the way back, but we've made a lot of progress. We are starting to see wages pick up a little bit, but still not terribly rapid.
Stephen, weigh in on what impressed you and what did not about this report, and what position does it put the Fed in?
I think what impressed me most is that there's not radical information that's going to deviate the Fed's course. So the numbers, as smooth as Josh mentioned, are in that 150 clip, which means the Fed is not going to deviate from their policy. We think that they're going to be one and done in December. That's predominantly because of international events, Brexit, what's happening in Europe. I think the Federal Reserve is inclined to raise rates. They want to be in what they would consider a normal policy environment. But the economy is doing okay. Earnings starting next week look to be improving into the end of the year. So I think it's going to be an okay economy. It's going to be an okay environment for the Federal Reserve. I don't think they're going to be very, very aggressive. We just think that the valuations in U.S. equities are getting very rich. So for us, we want to look globally. We want to have a multi-asset strategy where we can underweight valuations that are expensive and look in areas where valuations are a little bit more attractive.
You know, Stephen, a couple of weeks ago, maybe even more recently than that, an awful lot of guys who are market strategists like you and stock picking said, well, I see the S&P 500 ending the year, maybe getting back right around 2,100. That's my number, 21. Well, now we're at 2,130 or thereabouts. So what's the rest of the year look like from where you sit?
I think there's going to be chop. I think it's going to be bookended, kind of flat-ish. We think it'll be a positive number, U.S. equities, for 2016, but it's looking a lot like 2015 as well. A lot of volatility, flat-ish, a slight upward bias in U.S. equities, but we would be inclined to look at valuations getting rich and richer, trim that position. You don't want to do anything dramatic, but trim that position so that you can fund overweights, let's say, the European cycle, which is beginning. The European Central Bank is going to get very aggressive as our Fed is kind of stable in their policy path. So just be a very, I think, tactically lean into it, stay on your toes, and be actively managed.
Josh, why don't you follow on that? Because one of the things that Tyler and I were talking about right before the show is you have stocks rallying, but you also have bonds rallying, and you have gold rallying. You know, a lot of the normal relationships in the stock market are not gelling at this point. So how do you see things playing out, along with the fact that we have an election that's coming up in November?
Yeah, I think they are sending somewhat confusing signals. I think one way to maybe reconcile them is the stock market and risk assets are saying, hey, the economy's looking okay. You know, not great, but it's looking okay. Interest rate markets, are saying maybe it's looking okay, but monetary policy is going to be in easing mode in other parts of the world in a big way, and the Fed has certainly been pushed out. So that's what's helping to hold interest rates down. So it is a little bit of the best of both worlds. But I do think if the economy continues on a pretty good track, and we get some sense that the Brexit situation is not impeding activity meaningfully in the U.S., then I think the Fed will be back maybe by the end of the year.
Thank you, gentlemen. Have a great weekend.
You too.
Josh Feinman with Deutsche Asset Management, Stephen Wood with Russell Investments.
Potential risk to the market that we've been following is the fallout from the UK's vote to leave the European Union. But a new survey of chief financial officers shows only a small portion of those business executives think the vote to leave will have a negative impact on the U.S. economy. The bigger impact, according to the CNBC survey, will be, as you might expect, on the UK and EU economy.
That vote in the United Kingdom, along with global security, were just some of the topics discussed at the NATO Summit, where President Obama, along with British Prime Minister David Cameron, were in attendance. Hadley Gamble reports tonight from Warsaw.
Strength and unity, that's what NATO's Secretary General says this organization is going to have to continue to project, even as fears continue to mount over the breakup of the European Union, as well as governments here trying to decipher Vladimir Putin's next move.
We will continue to seek constructive and meaningful dialogue with Russia, to make our intentions clear, to dispel any misunderstanding, and to reduce the risk of military incidents or accidents spiraling out of control.
As the largest NATO summit in history got underway today in Warsaw, questions continue to be raised over just how far NATO should beef up Eastern Europe's security. A 4,000-strong multinational force will be deployed in 4 battalions ranging from Poland to the Baltic states. Several smaller NATO outposts will be created, as well as a rapid response force that could be deployed if needed. Now, while the troop buildup is aimed at deterring Russia from further aggression along NATO's eastern flank, officials here are walking a fine line between antagonizing the Kremlin and reassuring ex-Soviet member states concerned that they could be Mr. Putin's next target.
We have tripled the size of the NATO response force. We have established new headquarters in the east and further developed key capabilities like ballistic missile defense against threats from outside the Euro-Atlantic area.
Another potential game changer for NATO is just how much Brexit could impact the North Atlantic Alliance. The UK was a major force behind EU sanctions on Russia, and despite mounting pressure from other EU nations to roll them back, had held firm. They were also a major contributor to overall NATO spending, and with Washington keen to see more commitment from EU countries, it remains to be seen just how ready Europe is to foot the bill for their own security.
The vote in the United Kingdom to leave the EU has created uncertainty about the future of European integration. And unfortunately, this has led some to suggest that the entire edifice of European security and prosperity is crumbling. There are those who've been questioning, what does this mean for the transatlantic relationship? Let me just say, as is often the case in moments of change, this kind of hyperbole is misplaced.
For Nightly Business Report in Warsaw, Poland, I'm Hadley Gamble.
At the New York Stock Exchange this morning, a moment of silence was observed for the victims of the Dallas sniper attack, which occurred overnight following a peaceful rally. The moment of silence took place just before today's opening bell. Still ahead, looking for double-digit returns? How about 40% returns? Our market monitor tonight has some names she says will deliver. A major setback for the blood testing startup Theranos. Its founder and CEO has been banned from owning or running a medical lab for 2 years. The move comes after a months-long investigation where inspectors found a number of violations of federal testing standards. Theranos founder Elizabeth Holmes says she's disappointed by the decision. The company was founded as a way to deliver cheaper blood tests and was valued at $9 billion just 2 years ago.
Twitter reportedly wants to stream more live events. As first reported by Recode, the company is in talks with the NBA, Major League Soccer, and Turner Broadcasting to buy the digital streaming rights. The move is seen as a way for Twitter to attract users, and that helped send the stock higher.
Twitter's CEO Jack Dorsey is in Sun Valley, along with many other big names in technology and media. And as Julia Borston reports, there's growing concern about Silicon Valley's sky-high stock valuations.
For From Warren Buffett to Mark Andreessen, a range of big-name investors are here in Sun Valley, meeting with media and tech CEOs at the Allen & Co. conference. With the stock market still trading near all-time highs, there are big questions about whether private companies like Pinterest, whose CEO Ben Silbermann is here, will be able to hold on to their sky-high valuations. Airbnb's is now around $30 billion. But Kleiner Perkins partner Bing Gordon says going public isn't top of mind for many of these companies.
It's clearly a slowdown in IPOs. This generation of founders, and only think IPO is kind of a bucket list thing to check off and put on their mantle. And since the late 90s and some of the new regulatory regime, the IPOs are put off until companies are extremely healthy and extremely established.
Those successful startups Gordon is talking about may be staying private, but they're raising more capital than ever. Unicorns, private companies valued at $1 billion or more, raised nearly 40% of all venture capital in the first quarter, nearly $9 billion, according to a new report from PitchBook. But as more cash comes pouring in, former Twitter CEO Dick Costolo says the sky-high valuations for big tech companies could be at risk.
I think there is a sense that the valuations of the public companies and the valuations of the public tech companies are still pretty high and likely to come down.
And valuations coming down may make some of these companies here more attractive as acquisition targets, as LinkedIn was to Microsoft, which last month snapped up the public business network for $26 billion. For Nightly Business Report, I'm Julia Borston in Sun Valley, Idaho.
Polycom walks away from one deal but strikes another, and that's where we begin tonight's market focus. Polycom ended its merger agreement with tech company Mitel Networks. The video conferencing technology maker will now be bought by private equity firm Cirrus Capital for about $2 billion, an offer that Polycom says is superior to Mitel's. Polycom is expected to pay Mitel a $60 million termination fee. Shares of Polycom up nearly 13% to $12.27. Meanwhile, Mitel's shares surged more than 19% to $7.21. McDonald's says that it will take a $235 million charge in the second quarter because of refranchising thousands of restaurants and relocating company headquarters to Chicago. The change is expected to lower profit by 20 cents a share. Shares were up fractionally to $121.31.
Gap sees same-store sales rise for the first time since early last year. The retailer said the better-than-expected results were driven by strong sales in the company's Old Navy brand. Investors seemingly pleased with the news. Gap shares up nearly 5% at $22.68. Meantime, shares of Barracuda Networks took off today after the provider of cloud security products reported a rise in both profit and revenue. The results were sharply ahead of analysts' estimates. Shares of Barracuda up more than 18.5%. They finished at $18.43.
Our market monitor guest likes growth stocks she says could see double-digit gains over the next 12 months. The last time she was on, more than a year ago, she recommended Cray, which is up 8%, Priceline, which is up 17%, and Cisco Foods, which is also up 35%. She is Marianne Montaigne, Senior Investment Analyst with Gradient Investments. Welcome back, Marianne. Nice to have you here.
Thank you, Sue. Thank you.
Let's start with your picks. Because I know people are anxious to hear. You did so well with the last time you were here. Air Lease is currently on the top of the list tonight. Why?
Right. Well, Air Lease is a specialty financing company, and their specialty is leasing airplanes to the carriers. They just match up the orders with the manufacturers and these airlines who prefer to lease, and they make a spread. They make a small spread on every deal. But they sign these deals for about 7 years, and they have a high level of recurring revenue. It plays off the long-term trend of more people around the globe having access to air travel. And people have been very concerned about rising interest rates, but they've shown over and over again that they can weather through that. We think the valuation is extremely cheap at about a 35% discount from the PE versus the growth rate, which is in the mid-teens.
A potential 40% upside.
Right. We think that this should trade at a premium to the market. It is really a growth stock. And as we've seen year to date, the growth stocks, you know, as shown by the NASDAQ, are actually down slightly while the rest of the market is up 4% or better.
Your second one is another one whose PE ratio is below its growth rate, always a good sign, and that's Adobe Systems.
Adobe systems. So we all use the PDFs most every day, but they're very much involved in digital marketing and cloud cooperating software. They have 80% of their net revenues recurring, so this isn't the type of thing that's going to go up and down in terms of revenues and earnings. And yet, you know, people really haven't latched on to the software names this year, and so it's selling at probably a 20% discount from where we think fair value is.
And Skyworks is your last pick. It's currently in the low 60s, 30 to 40% potential upside. We have about a minute left.
Okay, so Skyworks is a component manufacturer for companies like Apple, but also many other companies like General Motors and Ford. So as we have the Internet of Things, we need more components. They're putting together more systems so they can be a one-stop shop for those manufacturers. And again, you know, discounted at 35% versus its growth rate. So we think that's very attractive.
All right, Marianne, thank you so much. Have a great weekend. Marianne Montaigne with Gradient Investments.
Coming up, a different kind of bright idea, one that hopes to disrupt our political system and change American democracy for the better. Most of the time, our bright ideas stories are about companies with real revenues and profits. Tonight, though, a different take, a look at a company still in a very early stage, not bringing in any money just yet, but it, of course, hopes to one day. It's a company that's trying to tap into this country's current fascination, interest in politics. It's run by a pair of San Francisco entrepreneurs who got what they hope will be the bright idea to start an online forum for real people having constructive political discussions.
There's one on whether or not the president should use the term radical Islam.
Matt Mahan and James Winden call their site Brigade. They also say it's the world's first network for voters. Users share opinions and discuss hot-button issues like the presidential race, funding education, or gun control. In a little more than a year, users have shared more than 6 million opinions. Those users come from all 50 states. The hope is the discussions can help people to find that holy grail, common ground, from which to develop real solutions to pressing problems.
What this is about is trying to enable people to self-organize, leverage relationships, and get things done.
Signing up is free. You merely provide your home address to help Brigade verify you. Users can see how their views stack up nationally and locally.
I just felt like if anything was going to make our politics work better, it would be social media.
Mahan first got the idea as a student at Harvard back in 2004. He lived down the hall from Mark Zuckerberg. Yes, that Mark Zuckerberg. Mahan used the Facebook, still in its infancy, to find other students likely to join a protest aimed at ending Harvard's investments in 2 Chinese oil companies operating in Sudan during a genocide there. In April 2005, Harvard divested.
So Facebook became a very efficient tool for figuring out who was best connected, who was likely aligned with me, and then as a tool to mobilize them to get behind a campaign.
In 2007, Mahan went to work for a company called Causes, a Facebook app that helped people connect with nonprofits. That's where he met Winden. At Causes, they saw 186 million people raise $48 million for various organizations. Winden was sold on the power of the digital platform.
When I started to compare the sort of impact you could have through technology in a matter of months or years, that sort of changed my perspective.
By 2013, though, Facebook was moving away from third-party apps. Determined to make another go of it, Mahan and Winden teamed with tech investors, big ones, Sean Parker, Ron Conway, and Mark Benioff in 2014, betting Brigade could be both useful and profitable. But how? Paul Reichhoff runs the nonprofit site Iraq and Afghanistan Veterans of America. The IAVA test partnered with Brigade last year. He thinks nonprofits will pay Brigade someday the same way recruiters pay to find prospective employees on LinkedIn.
Brigade gives us an opportunity to connect with someone who might be interested in gun rights, or they might be interested in immigration, or they might be interested in baseball. And if we can inject veterans issues into that conversation, then we can expand our market.
For now, though, Brigade focuses on individual users like Stefan Nicolo, an infrastructure investor. Nicolo thinks Brigade might make money selling its data.
There stands to be an opportunity to package that and make it available to folks who would have an interest in using that data. So think campaigns, think pundits, think networks.
Profit isn't the driver just yet. Mahan and Winden believe, though, that the path to that profit will become clear if they just stay on point.
At the core of politics, at the core of social change, are relationships. And the technology layer that we're seeking to build here is simply meant to allow individuals to leverage those relationships more efficiently, more effectively, and ultimately create more rapid change.
Well, you know, for years, investors fretted over just how Facebook could make money. It sure does now. And just a few weeks ago, of course, LinkedIn sold for about $26 billion. So with these guys, who knows? And they have some very, very substantial investors behind them.
And a lot of advice.
A lot of advice and nice offices.
Yes, exactly. That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for watching.
And thanks from me as well. I'm Tyler Matheson. Have a great weekend, everybody, and we'll see you back here on Monday night.